Hi everybody, it's Wednesday and we are on the floor of the New York Stock Exchange with Jim Cramer to break down today's market action. Jim, we are building on yesterday's losses. What do you think?
Well, actually we're not. Market's up substantially from when it opened, and a lot of that I think is the hangover we get from Europe. See, people want to sell us because Europe's so heavy, so we open down a lot, and then we start thinking, well, aren't we different from Europe? Are we really like the Italians, which has terrible regulation and high unemployment? Well, we have diminishing regulation. Look at the bank decision, right? To eliminate a lot of the Dodd-Frank important strictures, and we have higher unemployment. So I think people struggle with relating the two. Now, there'll be people who were brave enough to buy the opening, and they're going to flip. That's another trait of this market. If you buy it lower and we go up 100, people want to sell it, given the fact that they fear a tweet. But no, we trying to make a comeback as a recognition that nothing came out from the president that was negative versus yesterday, and you could argue that somewhat a little bit positive. But be careful, because once you have those gains and you get the flippers, it comes back down and maybe you get another chance.
But try not to focus so much on the tweet-by-tweet action of President Trump.
You know, it's just not. It's not investing. There are not a lot of people who are investing, and the way they invest, more than 50% of the investment is in index funds. So that money comes in regardless of where the market is. But if you're going to do individual stocks, I urge you to not buy when the tweets are positive and sell when the tweets are negative, because that's been a sucker's play. Look at Amazon, what we did with Action Works and Amazon, which is we built the position into the presidential tweets.
He certainly likes to tweet in the morning, President Trump.
Yeah.
So, meanwhile, Jim, Tiffany has been a mixed bag for retail, but not for Tiffany.
Right.
The stock is up 16%. Is it a buy at
and
this
Lowe's, Tiffany, and Ralph Lauren are all stocks where people felt that there'd be a miss. Ralph Lauren, because Kohl's missed, and because, and I can talk to you about whether it really missed or not, and you should read our bulletins, and Nordstrom, and that was the read-through there. So people were short Ralph Lauren. Obviously, that was wrong. Lowe's, it had been long Lowe's and short Lowe's, long Home Depot, and you're getting that reversal now. We're going long Lowe's and short Home Depot. It's literally the reverse of a very big trade that was going on, and what happens is that when you try to take these trades off, there's not a lot of liquidity, so that's the spike there. And Tiffany was a failure of Wall Street to recognize that the merchandising had changed. This is also what failed the Wall Street on Jeff Gannett and what he's done at Macys. In the old days, you used to see analysts far more attuned to what the stores look like. Now, a lot of the same analysts are still doing it, but they don't seem to understand that Gannett really revitalized Macys. And you saw the same thing with Tiffany, which was a major change in the merchandising. And that's what's driving the win at Tiffany, 7% versus 2% that people are looking for. And also the weaker dollar. Now, the dollar's getting stronger, so you may lose that. But that did bring a lot of people back into the stores.
You'll be talking to Jeff Gannett at our conference for the deal, June 7th.
Indeed.
So we'll look forward to that. Meanwhile, Jim, you spoke to the CEO of Union Pacific last night. He's very bullish on tax reform. I feel like we're not hearing enough about tax reform lately.
I think that it's being overshadowed by what's going on in Europe and overshadowed by the president and what's really going on in trade. And it's very hard because the underlying reason why you want to be excited about the U.S. market is employment. Because a country that has great employment is a country that's going to produce great numbers. But right now we're seeing the downside of employment, collateral damage, can't find as many workers as you could, downside of restricting immigration, fewer people in the workforce, downside of the country's demographics, not as many babies as people actually, the demographic is such that we went down. You're starting to look at the people coming into the workforce from the Great Recession. And there's just not a lot of people. And so I think that you have to recognize we had a downturn in births beginning in 2000 that was somewhat exaggerated, but these are all playing a role in the decline of the number of people going into the workforce. And a lot of people went on disability and they can't come back into the workforce. So This is a continual theme: tightness of labor, collateral damage to having such plentiful jobs.
And with Union Pacific, though, they do have some exposure to Mexico. Is that a problem with the NAFTA uncertainty out there?
It's a good question. They were very positive about how NAFTA talks are going to play out, and so therefore, I think that what that will mean, just so we know, is that you're going to deal with the same to and fro from the president on NAFTA that you're dealing with in China. So fortify yourself, because if you're going to trade every tweet, you're going to lose money.
You also had the CEO of Micron on last night. I think there was some worry about their low PE just in case the earnings didn't materialize, but he's embracing it.
And what I had been saying, and there were some people critical of me on Twitter, what I've been saying is that I was trying to explain to people what happens is that people don't believe in Micron, and that's what the low PE means, and they're waiting for anything that indicates that it's going to roll over. But then when Cisco said it's not going to roll over, DRAM pricing, then that was the call to say, you know what, maybe it's for real. And that's when Cisco said that, that's when Micron started coming back, which is why for the minute dash, I became much more constructive on Micron, and I remain constructive. And yes, you missed 4 points. Okay.
Yeah. And the CEO confirmed the strength of DRAM pricing in your interview.
Absolutely. Not Flash, but Flash is not falling off the cliff. So Micron is a stock that when it was down today and it was 1 point trading at 58, that's your chance. You have to be opportunistic in taking your chances.
What do you have coming up on the show tonight, Jim?
We've got Carnival, and people hate those stocks right now. It's part of a bear market in cruises, mini bear market, like the mini bear market in housing, mini bear market in airlines. It doesn't really matter which one. Now, I think that Arnold Donald's done a remarkable job over the years, and you're dismissing a tremendous number of technological improvements that Carnival's doing. I'm going to look into that.
All right, we'll be watching that tonight, 6 p.m. Eastern on CNBC. Meanwhile, we're going to continue talking about stocks and our Action Alerts
Plus. Yeah, I mean, again,
I've
been adamant about this because I think people only watch this broadcast. I offer a substantive analysis of a series of stocks that are owned by the Chapel Trust every single day. But again, I understand the notion of free media, but the free media people are getting a third of the story. So I know that Action Alerts cost money, and I know people don't want to pay, but I look at Action Alerts versus, say, brokerage fees, and Action Alerts versus, say, annuities, or people just paying 1% for a broker, and I question why that's all you want. So there it is, a plug for this, because I've labored for about 14 years in this thing, and I think more people should take it because I'm working harder than ever. And if I'm going to work harder than ever, you're going to be the beneficiary of it.